I'm Doug Olin. I'm principal in the Greenwich office of Cummings & Lockwood. I'm going to talk about qualified small business stock today. And this is actually a really positive provision in the tax code that has gained more and more popularity as time has gone on. And it's not often that the New York Times will write about planning techniques and praise the ingenuity of the tax avoidance industry. And I guess that's kudos to all of us that are in the room today that are taking advantage of the provisions under Section 1202 of the Internal Revenue Code to maximize the advantage provided by the capital gain exclusion under Section 1202. So my goal today is going to be to educate for those that don't know about Section 1202, talk about what a qualified small business is, talk about qualified small business stock, and then how to implement what the New York Times is talking about in multiplying the exclusions that are available and implement these stacking strategies. So in general, most people think about 1202 as a $10 million gain exclusion. Well, that's kind of true, and yet it's even better than that in some circumstances. 1202 first became law in 1993, and it was roughly a 50% exclusion of that $10 million of capital gain. That was increased in 2009 to 75%, and then increased again in 2010 to 100%. And after 2010, this provision needed to be renewed every single year. And you know how Congress operates. It's not easy to get Congress to enact something or reenact something every year. In 2015, it was made permanent, this 100% exclusion. And so I put permanent in quotes because, again, it's Congress and nothing that happens in Washington is permanent. We know that. And so what is this $10 million exclusion? How do we design a company to qualify as a qualified small business? And then how do we ensure that the stock that we have in that company is qualified small business stock? Because there's a lot of savings to be had. Before I talk about that, I should give you a little bit of a warning that, President Biden, when he came into office and proposed Build Back Better, he wanted to cap this benefit for people that make over $400,000 a year, which would have really significantly reduced the benefit of 1202. It didn't get passed, and it wasn't included in the Inflation Reduction Act. But this is something that's always on our minds. If the Democrats have another shot after the 24 election, we might see more proposals like this. So how do we design a qualified small business? What are the requirements to have one? And so first of all, it's got to be a C corporation. It can't be a LLC or a partnership or an S corp or any of these specific types of C corporations, a DISC, a RIC, a REIT, or a REMIC. All the great tax acronyms that we have. So it's got to be a C corporation. And that might be one of the reasons why the New York Times is writing in 2021 about something that's really been the law since 2010. It's because the income tax rate on C corporations was reduced in 2018. And it went from 35% to 21%. So the income tax penalty was no longer as great to set up a C corporation. So it made it a little bit more palatable. And what are the other requirements? The company has to have less than $50 million of assets, gross assets, the day before the stock was issued and the day after the stock was issued. So if the company is just a great idea and it's not worth very much, doesn't have many assets beforehand, maybe it's got $1 million of assets, but it raises $100 million in an offering, well, that company won't qualify as a qualified small business because it has to have assets less than 50 on the day before and the day after. On the day after, in that example, it's going to have $100 million and won't qualify. It has to file reports with the Treasury and with the shareholders. Government hasn't told us yet what those reports are, so we don't have to really worry about it. It's got to be a qualified trade or business, and I'll get into what those requirements are. And it's got to be an active business. The assets of the company can't be more than 10% real estate and more than 10% portfolio stock or securities. So 80% of the assets of the business must be used in the active operation of that business. So what companies will qualify as a qualified trade or business? If I asked everyone in the room to stand up and then sit back down when I called their business, everyone, when we're done, would be sitting down, because you can't practice law or accounting or insurance or investment management or securities or financing or leasing and all the other types of businesses that you see. But if it's not listed, then it can qualify. And so, like the New York Times article was talking about tech companies and the tech venture capital investors being able to really take advantage of this. But my finding is that it's really expanded. Most of that tech is happening on the West Coast, but now we have a lot of clients that are setting up businesses and really structuring them from inception to make sure that they qualify for this exemption because of the tremendous amount of tax savings that are available. There are shareholder level requirements. So first I went over what it takes to be a qualified small business. Now what makes us have QSBS, qualified small business stock? Well, you've got to be an eligible shareholder. So the stock in your hands counts as QSBS. To be an eligible shareholder, you just can't be a C corporation. So the company itself, the QSB, has to be a C corporation, but the holder cannot be. The holding period, in order to take advantage of this gain exclusion, and I'll talk about what that is, you have to hold it for at least 5 years. And you have to receive the stock at original issuance from the company in exchange for cash or property or for services performed on behalf of the company. Now, original issuance does not mean the very first time that the company issues stock. It just means that you are receiving the stock directly from the company, not from a third party, unless you're receiving it pursuant to a permissible transfer. And we'll talk about what that is in a little bit. There are other limitations that apply both the company and shareholder level regarding redemptions. And so basically the code is trying to limit the ability for people to get cash back out of the company in exchange for their stocks. So I'm not going to go into that, but just know when you're testing to see if you have QSBS, you need to look at whether there have been any redemptions in the 2 years before or the 2 years after the issuance of the stock. Now, you can own QSBS personally, so as the taxpayer, I can hold it, or I can hold an interest in an entity, an FLP or an LLC, that owns the QSBS, and I will get the tax benefit as the partner in that partnership, as long as the partnership has held the stock for at least 5 years, and I have been a partner in that partnership for the entire time that the partnership owned the QSBS. And these rules get important when we're looking at, because this is a valuable benefit, right? We're avoiding taxation on $10 million of gain and maybe more, and when we extend it out, multiplying that $10 million of exclusion times 2, 3, 4, 10, however many opportunities we have. So what is the gain exclusion? The maximum gain exclusion for any taxable year, right? So that makes us think that, all right, this gain exclusion doesn't just apply in 1 year, we can apply it multiple times over the year. And it applies to each issuer. So if you're a venture capital investor, and you've got interest in multiple entities, you can get this exclusion for your stock in each one of those investments that you've made. So it's the greater of $10 million minus the gain that you've excluded in prior years for that same issuer, or 10 times basis, the basis that you have in that stock. So you can get the $10 million exclusion, and you can also get, if that doesn't cover all of the stock, you haven't sold all of the stock to get that $10 million exclusion, and you still have more left over, you can still get 10 times your basis excluded after that as well. It's easier when talking about it to talk about it as a $10 million exclusion. But there are two pieces to it, and it's the greater of, and you have to test each and every year. But when you're excluding $10 million of capital gain, and Connecticut and New York follow the federal as well, so it's a significant benefit. So if we can do even better, it takes us to the next level. So let's talk about estate planning with QSBS. You can do estate planning with QSBS as long as you follow the rules. And the rules would require that the stock be transferred via permissible transfer. And that's, a pretty small category, but pretty broad in a planning sense. So a permissible transfer is a transfer by gift, at death, or from a partnership to a partner. And it's important, the distinction there, not from a partner into a partnership, only from a partnership out to a partner. If the transfer is by permissible transfer, then the new holder is treated as having acquired the stock in the same qualifying manner, so directly from the company in exchange for cash or property or performance of services, right? So that checks off that box. And you get to tack on the holding period. So when a gift is made, you don't reset the holding period. The donee gets the same holding period and can keep tacking on to what the original holder had. Now, there's an impact in basis that happens when you make a gift. That's typically a carryover basis, perhaps with an adjustment if gift tax was paid. But at death, there's a step up in basis, or a mark-to-market in basis. And so I see people's minds turning like, wait a minute, we can get a full step up and then multiply by 10 times that new basis for the exclusion. And the answer is no, too good to be true. There's a special carryover basis rule that applies there. Unless, of course, and the IRS, they don't miss an opportunity to make a dig. If the value's gone down, they're actually going to step you down in basis at death in order to figure out the 10 times basis for the capital gain exclusion. $10 million of exclusion is great, but let's try and get some more. So let's make some gifts and let's multiply the exclusion. Let's stack $10 million on top of $10 million. How do we go about doing that? Gifts to grantor trusts. Maybe even sales to grantor trusts, maybe grats, things like that. These are, common planning techniques that we use. None of them will work for stacking the $10 million gain exclusion because each of those three strategies involve a grantor trust. That's not a separate taxpayer for income tax purposes. And so we're not going to get a separate capital gain exclusion under 1202 if the recipient is a grantor trust. So then where do we look? Well, what about outright gifts to individuals? Brothers, sisters, parents, those all count. You can make a gift to your family members, they'll all get a $10 million gain exclusion as well, or the 10 times basis. What about gifts to your spouse? Can I have stock and then just give some of that stock to my wife and she'll get a $10 million exclusion as well? If we file separate returns, the tax code is clear. The answer is no. I'll only get $5 million and she'll only get $5 million. But if we file joint returns, a lot of people think the answer is yes, and the legislative history kind of leans that way. I would leave that as an uncertainty at this point, but I think a lot of accountants that I've talked with are taking that position on returns that they file. And what about grantor trusts? We don't love, as planners, to be making outright gifts to individuals. We lose the protection from generational taxes, we lose the protection from creditors and divorcing spouses and things like that. We want to have the protections that trusts afford. So we know we can't make the gifts to grantor trusts, we'll make them to non-grantor trusts, which are foreign to a lot of people because so much of what we do is planning with grantor trusts. So this is making us pivot a little bit from our traditional planning, and now for QSBS, we're planning with non-grantor trust. Easy example, client with 3 kids sets a separate non-grantor trust for each of the 3 children and gifts QSBS to each of those 3 non-grantor trusts. We've now stacked 3 additional exemptions on top of the clients, and now we have $40 million of capital gain exclusion when the positions in that QSBS are sold. A lot of clients, especially now, because clients are making such significant gifts, again, a lot of the limitations are, there are so many ways to multiply this exclusion, but do we have enough gift tax exemption to do it, to actually give away enough stock where we need 40, 50, 60 million dollars of gain exclusion? But now's a good time to be thinking about that before perhaps we lose the exemptions. And a lot of clients, for safety, like to include their spouse. They like to set up a cert or a slat because they're giving away so much. They like having that safety valve. Well, it's really hard. I shouldn't say it's really hard, but it's harder to set up a non-grantor trust that includes a spouse than setting up a grantor trust that includes a spouse. And a lot of clients like to have each spouse set up a slat for the other. And you need to be a little bit careful when designing these trusts because there's a code provision that will kind of treat 2 trusts or multiple trusts as the same trust. And this is not geared towards 1202, but a lot of practitioners are concerned about it when designing trusts for 1202 because making the trust different and getting the stacking ability is so important. And so this provision says that if you have 2 or more trusts, they're going to be treated as the same if they have substantially the same grantor or grantors and substantially the same primary beneficiary or beneficiaries, and a principal purpose is the avoidance of the income tax. Oh, and by the way, husband and wife are going to be treated as the same person. So if husband sets up a trust for wife and kids, and wife sets up a trust for husband and kids, if husband and wife are the same person, do we have the same beneficiaries? So just be careful when talking with your clients about designing these trusts. Section 672 to 678 are basically the grantor trust provisions. And so we're familiar with drafting grantor trusts and the provisions that we intentionally include in those trusts in order to make the trust a grantor trust. Now we have to avoid including those provisions. And I've just kind of included a table of contents of what those provisions are, but don't want to spend a lot of time talking about them. I do just want to hit on section 677 because that's the grantor trust provision that deals with spouses, right? When we set up slats or certs, and normally we don't have to worry about it so much, but to make a non-grantor trust, if we want to include our spouse, we have to require the approval or consent of an adverse party to make distributions to that spouse. An adverse party is going to be someone with an interest in the trust, a beneficiary of the trust. So do you want to have your kids with the approval to make distributions to your spouse? If your kids are the other beneficiaries of the trust, that's what you're going to have to do in order to include your spouse and avoid grantor trust status. There are other ways that you could lose that QSBS status that you need to pay attention to. Number one, I mentioned that a distribution from a partnership out to a partner of QSBS maintains the status. The other way around, if you contribute it into a partnership, you will lose your QSBS status. And lastly, a lot of clients don't own their QSBS directly. They own it through a partnership. Well, Section 1202 appears to say that if you make a gift of that partnership that owns the QSBS, the new owner of that partnership will not qualify as QSBS. It will not be QSBS in his or her hands or the trust's hands. And so you need to be careful. There is a regulation under 1045 that would make you think the opposite. 1045 also deals with QSBS, and I'll hit on it briefly. It's a gain rollover provision. If you haven't held your QSBS for a full 5 years, but you want to sell it, as long as you've held it for more than 6 months, Section 1045 allows something like a 1031 like-kind exchange rollover of the capital gain. So you can sell your QSBS and you have 60 days to reinvest the proceeds into new QSBS. You keep your same basis, you can tack on the holding period and hopefully hold it the full 5 years and get the benefit of the $10 million gain exclusion. So 1045 is a good provision to know about as well. Thank you.